So before we get into the changes, it's important to make sure we understand how credit scoring works now. So as most of you know, credit scores are a numerical representation of a borrower's creditworthiness. So essentially that's meant to assess how much risk a lender poses borrowing, letting a consumer borrow from them. So the higher the scores equal better loan terms, lower scores equal higher interest rates or potential denial. Understanding the weight of the credit scores is also crucial if you're in the lending space. And it's also very important for a consumer to understand as well, which most consumers just don't have a strong understanding of this. This picture you see here, and actually I'm going to turn on my pointer so you can see where I'm pointing, laser pointer. This picture right here is a snapshot of the foundational components that drive the current credit scoring model. The way the data is interpreted, so the way the data for the 30% of accounts owed or 35% of payment history is interpreted can vary from model to model. And we're going to look at those models here on the next slide. So in lending right now, what you are using to qualify a borrower for a mortgage is known as FICO Classic. So for Experian, that's Model 2. For TransUnion, that's Model 4. And for Equifax, that's Model 5. So lenders that are offering conforming loans, which are loans eligible for purchase by Freddie and Fannie, have been required to use this FICO Classic model. Traditional credit reports don't consider trended data, which is something we're going to be looking into here soon. And that can offer a misleading picture of risk. And we're going to see exactly why that is and why we're seeing these changes. So a little history. When I had mentioned on the last slide, there's different models. This represents all of the different FICO score models heavily used today. There's actually two types of scoring that aren't on this chart, and that's FICO 10 and FICO 10T. So something important for you to know is that the credit bureaus, Equifax, Experian, and TransUnion do not create the FICO credit score. Fair Isaac Corporation makes that FICO score, and that's what FICO stands for, is Fair Isaac Corporation. The bureaus are given these algorithms. Those algorithms are then housed on their internal servers, which allows them to not only create the credit reports, but provide those credit scores. And over time, the new models of the FICO algorithm are presented based on changes in consumer behavior. So that's why we have all of these models available today, as there's been changes in what determines risk. They've introduced new models that can more adequately interpret this.
Are the models just weighted?
Yeah, go ahead.
I was going to say, are the models all just weighted differently? Is that what separates like score 8 from score 10 and 10T, or are there other factors that are coming in, like aside from what we see here?
So this baseline component is the same. It's the way the information is interpreted that's different. For example, in some of the newer model, like in my Model 10, a paid collection no longer adversely impacts the score in the same way. There's time weighting differences as well. In newer models, like a late payment is less impactful after 2 years, where in the old model, FICO Classic that you use in lending, it doesn't matter if a late payment happened 2 years ago or happened last week, it's going to impact the credit score just as severely. So it's the interpretation of that information that's changed over time. Does that answer your question?
Yeah, that totally answers it. Thank you.
Absolutely. Let's see. So in 2014, FHFA basically introduced the new requirements that we're going to discuss more today. These requirements were to essentially review the algorithm that's going to be used in lending, because there just was no actual review happening and no time frame to where they said we need to look at changing the credit score models that are used. So in 2018, they required that process to be put in place, where they're validating and approving the new credit score models. And what was proposed, excuse me, if I cough a little bit, I've been getting over a cold, so bear with me. So what was proposed was the approval of FICO 10T and Vantage Score 4.0. Okay. Okay. Bear with me. Goodness gracious. Okay. So the idea of proposing these two new models was they're supposed to be more accurate. And there's a lot more innovation in the creation of these models, and a lot more inclusion for the consumer base. So this was posed years ago, and we're just now finally seeing the transition into the usage of these new models. Okay, so let's look at that more. Now I mentioned VantageScore in this last slide. I want to explain what VantageScore is. Has everybody heard of a VantageScore before? No? Okay. Has everybody heard of Credit Karma? Yes? Okay. That's a VantageScore. So in 2006, the credit bureaus said, we want to own credit scoring. We don't want FICO owning credit scoring. So they banded together, even though they're their own private separate companies, and they said, let's create a credit score together, and we want to rival FICO. And that's when VantageScore was born. So VantageScore, created in 2006, interprets this data differently. So I have this chart here on purpose. I kind of cut it off here, but you get the main idea. I have this chart to show you the difference in the weightings, right? Payment history is 40% versus 35%. Credit utilization in FICO 8's 30, well, in FICO in general is 30% versus 23% in the VantageScore, et cetera. So you're going to see very different scores. I'm sure you're all used to seeing that, right? Somebody comes to you, I'm a 700. No, you're a 620, right? It's an entirely different model. It functions in a very different way, and we'll look at some of those differences on the next slide. So with the creation of this model, the whole idea from the bureaus was, we want to take over providing the credit scoring that's used in lending. So this creates a lot of consumer confusion, because now not only do we have a FICO credit score and a Vantage credit score, but we've got different models, right? In FICO, we've got 8, 2, 3, 6, 5, etc. In Vantage, we also have multiple models. We've got 3, 4, and 6. So this leads to a lot of confusion for consumers, and then also for those of us in finance as well, if you're not aware of this. So VantageScore and FICO score, here's some of the differences between the two. This is all a summary of where we are today in credit scoring. We have a FICO score with many versions of the algorithm. And again, FICO Classic is the version that's used in the mortgage lending space right now. When it comes to personal loans, credit cards, auto loans, they may be using other algorithms. I'm going to keep going back and forth on these slides, but we see here there are industry-specific versions of the credit score. I'm not going to go into the details of how those are different for today's purpose, but they do function a bit differently. And the VantageScore is largely not used in any area of lending. 95% of lending decisions are based on the FICO score until now. So I'll let you take a minute to read some of these differences here. And you may be wondering why I'm discussing these differences in the two score algorithms, or it may be obvious by now.